This is week 5, and this is the second lecture for this week. And today it is 18th of November, Wednesday. Okay, so in the previous lecture, I have explained about the second type of adjusting entries, and then this is the third type. This third type of adjusting entries is for prepaid expenses. Prepaid expenses is something like this. There is a business. The business pay expenses in advance. Some businesses do something like this. For example, a business pay, let's say, what kind of expenses? So the easiest example is a business pays rental in advance. There is a business. The business pay 3 months rental at once. So let's say this month is November. The business pays rental today for November, December, and January next year. So there's something, there is an adjusting entry that has to be done for this situation. Okay, let's see this sample example. On October 1st, 2019, Apex Incorporated pays $3,600 for 1 year's rent in advance, covering 1st of October 2019 to September 30th, 2020. On December 31st, 2019, an adjusting entry will be needed. Okay, for this situation, you have to know how to do the adjusting entry. The first thing that you have to ask yourself is how much is the rent expense for year 2019. So you can calculate the rent expense. See here, the payment 3,600 is for rental for 1 year. So how much is the rent expense for 1 month? 1 month, the rental is 3,600 divided by 12. So 1 month rental is $300. So now you know that the rental for 1 month is $300. How much rental is the rent expense for year 2019? So you have to calculate how many months in 2019 the business rent the building. So see here, for the year 2019, the rental is for the month of October, and then November, and then December. So 3 months. So now you know from 3,600 payment, only 900 or 3 months is rental expense for year 2019. The balance 2,700 is rental expense for year 2020. Given that this business will close its account in 31st December 2019, you have to record the $900 as rental expense in year 2019. Okay, so how to do the adjusting entry? For this, for prepaid expenses, the first thing that you have to do is you have to know what is the record or journal entry when the business pay $3,600. Okay, so on 1st of October, when the business paid $3,600, so the record is like this. Cash, when the business paid $3,600, cash out. So asset cash decrease. So the record is credit account cash 3,600. At that time, at 1st of October 2019, the business cannot record the 3,600 as rental expense because the business does not use the building yet. At 1st of October, the business pay first. After that, the business use the building. So on 1st of October, the record is credit account cash 3,600, but the business has to debit account prepaid expense. Account prepaid expense, like I said earlier, is an account that is used by the business to record advance rental expense. In accounting, when a business pay an expense in advance, you have to record it as an asset because the business pay today, but the business will get benefit from the payment in the future. So for rental, the asset account is called prepaid rent. Okay, so debit prepaid rents, credit account cash. That is the record on the 1st of October 2019. Now the adjusting entry has to be done at the 31st December 2019. So how to do the adjusting entry? Okay, first, like I said earlier, you have to calculate how much is the expense for the year, how much is the rent expense for the year 2019. We have calculated that and found that for the year 2019, the rent expense is $900. So when you know that the rent expense is $900, at 31st of December 2019, you have to record the rent expense. So how to record that? This is the record or the adjusting entry. 31st of December 2019, you record the rent expense. $900. Expense increase, you have to debit. That's why you can see here the adjusting entry is debit rent expense 900. At the same time, you have to reduce the account prepaid rent because asset prepaid rent has decreased 900. 3 months has passed since 1st of October. So $900 from the 3,600 prepaid rent has been used or has become an expense. So that is the adjusted entry. Debit rent expense 900, credit prepaid rent 900. When you reduce the prepaid rent, you credit the account. That's why the journal entry is prepaid rent credit 900. Okay, this is the adjusting entry type number 4, type 4. This is adjusting entries for unearned revenues. Unearned revenues is something like this. There is a business, the business receive cash from a customer, but service has not provided yet, or things have not been sold yet. So when a business receives cash from a customer, but the service or service have not provided yet, or things have not been sold yet, the business cannot record the cash as revenue. Because in accounting, remember, we record revenue when the transaction happen. In accounting, we record revenue when seller deliver product to customer, or when business provides services to a client. But here, unearned revenues is a situation where the business receive cash, but service has not provided yet, and also or things have not been sold yet. Okay, so let's see. In accounting, unearned revenues is recorded as a liability. Why? Because unearned revenue is a situation like this. A business receive cash, but the business has to do something for the for its customer or client in the future. It is like a debt. The business has to do something in the future for the customer or client. So let's see here the situation, the example for unearned revenues adjusted entries. On March 1st, 2019, a business received 3,600 for 1 year rent in advance, covering March 1st, 2019 to February 29, 2020. So see here, the business received cash 3,600 from somebody. But on that day, when the business received the cash, the service, the rental service, has not been provided yet. After the business received the cash, then the business provide the rental service. So that $3,600 in accounting, we record it in an account called unearned revenues. It is a liability. It shows that the business has to provide rental service to this client in the future or after the payment is received. Okay, so on December 31st, 2019, an adjustment will be needed. So adjusted entries is needed for this kind of situation. So how to do the adjusted entries? Remember, when you do adjusted entries, you have to decide how much is the revenue or expenses for the accounting year. In this situation, the accounting year is 2019. So you have to decide from this 3,600, how much is rental revenue for year 2019. So now you calculate. First thing is to calculate how much is the revenue. The unearned revenue is a liability. At the end of the day, how much from this liability becomes revenue for the business. So the total rental, the total payment or cash received is 3,600. This payment is for 1 year. So how much is rental revenue for 1 month? 3,600 divided by 12 months. So 1 month rent revenue is $300. Okay, so that is the first thing. And now second thing is you calculate for the year 2019 how many months the rental service has been provided. So the rental service is started from March 1st. So March, April, May, June, July, August, September, October. September, October, November and December. So 10 months has passed. 10 months has passed. So it shows that the business has to record 10 months rental revenue. 1 month 300, 10 months $3,000. That is the rental revenue for the business during the year 2019. So how to do the adjusted entry? How to show the adjusted entry in the form of general journal? Okay, so the first step to do the adjusted entry is to know what is the record on 1st of March when the business received the cash. Okay, imagine when the business received the cash in or cash out. So that is a cash in because there is a business and one day the business received cash from somebody. So cash goes in. So what is the journal entry on the 1st of March? Debit account cash. The amount is 3,600. And then the second thing is the business cannot record that cash as revenue because the rental service has not been provided yet. The rental service is provided by the business after receiving the cash. So debit cash 3,600 and then credit account liability, which is the account rent revenue. Remember I told you, when a business receive something from a customer but the business has to do something in the future, you record it as a liability. The name of the liability in this situation is unearned revenue. It is not rent revenue yet. unearned rent revenue. Okay, so that is the original entry. And now the adjusting entry has to be done at the end of the year when the company closed its account at 31st of December 2019. So what the business has to do at the end of the year? At the end of the year, at 31st of December 2019, the business has to calculate the rental revenue for the year. We have calculated that number. The rental revenue is $3,000, which is 10 months rent. So the business has to record the revenue. According to the law of debit and credit, the rule of debit and credit, when revenue increases, you have to credit the account. So the adjusting entries is credit account rent revenue 3,000. When you credit the rent revenue, the revenue is coming from the liability account. You have to reduce the liability account and to increase the revenue account. That's why you have to debit the account unearned rent, the liability account unearned rent. You take 3,000 from that liability. Because the liability has become revenue. So at 31st of December 2019, revenue has increased, but the liability of unearned rent has decreased. Okay. I have explained 4 main types of adjusting entries. There are additional adjusting entries for you to know. One of it is depreciation. Okay, depreciation is related to non-current asset owned by a business. Okay, let's see here. If you have a business, your business will have many non-current assets. Non-current assets are assets that have useful life of more than 1 year. The assets can be used or can be utilized for more than 1 year. The typical example is land, building, motor vehicle, equipments, etc. Okay, see here. The first thing that you have to know related to depreciation is how to record the purchase of non-current asset. Okay, remember this. When you record the purchase of a non-current asset, the value of the non-current asset has to include the purchase price of the asset plus cost to acquire or to get or to purchase the asset and getting it ready for its intended use. This cost includes sales tax, shipping, installation, and other costs. This is very common, happen to every business. Let's say there is a business and the business purchase an equipment. The business has to pay the cost of the equipment. For example, let's say the cost of the equipment or the price of the equipment is $1,000. At the same time, the business also has to pay the shipping cost or delivery cost. Maybe the business has to pay value added tax, and also the business maybe has to pay installation cost, cost to put the equipment in the shop or in the premise of the business. So when you record the purchase or the value of this fixed asset or non-current asset, you have to add the price and the cost to acquire or to get the non-current asset. So let's see an example here. Let's say a business, see the green box here, a business purchased a sewing machine for $5,450. At the same time, the business has to pay $50 for shipping for that sewing machine. The business paid 3,500 cash and will pay the supplier $2,000 later. Okay, now the first question. How much we have to record the value of the machine, the value of the non-current asset machine? The answer is the value of the non-current asset machine that has to be recorded in the business accounting record is 5,450 plus $50. The price of the sewing machine is 5,450, and then you have to add $50, which is the cost to acquire the sewing machine, the shipping cost. So when you want to record that, you have to record it like the record that you can see here. Debit sewing machine 5,500. That number is coming from 5,450 plus 50. And then you debit account sewing machine because that is an increase in asset. Before the purchase, the business has no sewing machine. When the business purchase the sewing machine, there is an increase in non-current asset sewing machine. So you debit account sewing machine. The amount is 5,500. At the same time, when the business purchase the sewing machine, the business pay cash 3,500. Cash is an asset. When the business pay cash, there is a cash out. So asset cash decrease. When asset cash decrease, you have to credit the account cash. That's why you can see here the second entry is credit account cash 3,500. And the situation here is the business will pay supplier of the sewing machine $2,000 later. It means that the business owe $2,000 from the $2,000 to the supplier. It is a liability. In accounting, when a business owes some amount to a supplier, you have to record it in a liability account called account payable. So that's why you see here in the journal entry, you have to credit account payable $2,000. So this is the way to record the purchase of non-current asset. The example here is sewing machine. If you have a situation where a business purchase land or building or motor vehicle, the way to record that purchase is same like this one, same like this example. You have to debit the account for the non-current asset, and then you have to credit the account cash, and maybe you also have to credit the account payable. Okay, so as time passes, a fixed asset or a non-current asset loses its ability to provide useful services. This decrease in usefulness is called depreciation. Okay. If you have a business and one day you purchase an equipment, you know that the longer you use the equipment, the value of the equipment will decrease. So in accounting, we record the decrement of the value of the asset as a depreciation. We record it as an expense. It is called depreciation expense. So see here, depreciation. The second point here, depreciation is the cost of allocation that assigns the original cost of plant and equipment to the period benefited. So basically, depreciation expense is the amount of decrease in value of a non-current asset that we record as an expense in accounting. Book value. Okay, this is another term that you have to know related to depreciation. Book value. Book value is the asset's original cost. less any accumulated depreciation. Okay, you will see that in later slide. And then the third point here, the fourth point that you can see here is salvage value. Salvage value is the amount expected to be received when the asset is sold at the end of its useful life. The situation is like this. If you have a business and then one day you purchase an equipment or other non-current asset, most of the time, at the end of the life of the equipment or non-current asset, the equipment, it cannot be used anymore, but it still has some value. Maybe it can be sold as scraps, or it can be sold as a second-hand item. So that value is called, in accounting we call it salvage value. Okay, this is the way to calculate the depreciation. Like I said earlier, depreciation is a decrease in the value of an asset after the asset is used over time. Okay, let's see. The calculation is very simple. See here, there is an example. So when you want to calculate the depreciation expense, there are several methods that can be used. But in this course, you have to know only one method. The method is called straight line method. So using straight line method, the way to calculate the annual depreciation expense is using this formula. You can see the first green box here. The formula is annual depreciation expense equal to cost of the non-current asset minus salvage value divided by estimated useful life of the non-current asset. See the example here. Let's say a business purchases a washing machine. The price of the washing machine is $5,000. It is estimated that the useful life of the machine is 4 years. Useful life means the business estimated that the machine can be used for 4 years. So the salvage value of this washing machine is 600. So it means that at the end of year 4, the value of this washing machine, maybe scrap value, maybe second-hand value, is only $600. So if this is the situation, how much is the depreciation expense, and also how to record the depreciation expense at the end of the year? Okay, so if you have to calculate the depreciation expense for this washing machine, the way to calculate it using straight line method is like this, like the one that is shown in this slide. First, you have to show the cost of the machine, $5,000, and then minus the salvage value. The salvage value is $600, and you have to divide everything by 4, which is the useful life of the washing machine, 4 years. So the answer is a depreciation expense for 1 year is $1,100. So to record this depreciation expense at the end of the year, you have to record it like the bottom green box here. First, you have to record the depreciation expense. You have to debit the depreciation expense account. The reason is, according to the rule of debit and credit, when expense increase, you have to debit. So that's why you debit account depreciation expense, 1,100. And then you have to credit an account called accumulated depreciation. The amount is also 1,100. You have to memorize this. This is the there is a longer explanation for this, but to make it easier for you, you memorize this first. Every time you have to record depreciation, the way every time you have to record depreciation expense, this is the way to do it. Debit depreciation expense, credit accumulated depreciation. That is the way. Later I will explain more about this when you want to prepare an income statement and balance sheet. I will explain more about this. I will explain where to put these two numbers in the income statement and balance sheet. Okay, this one is the last one. This one is also journal entries that have to be made at the end of the year. This maybe it can be called as adjusted entries for supplies. Okay, remember this, supplies. Supplies are things or items that are used by service businesses when the businesses provide services to customers. For example, let's say there is a laundry shop. Laundry shop is a service business. A laundry shop provide laundry services to customers. The laundry shop does not sell anything, but when the laundry shop provides services to customers, the shop has to use detergent and softeners when the shop do the laundry service. The detergents and softeners in accounting we call them supplies. They are things that the service business use when the business provide services. The laundry shop does not sell the detergents and softeners. They use them. Okay, this kind of items are called supplies. So there is a way to do accounting record for supplies. So let's see this situation. Remember this point. Supplies, when you have them in the shop, they are assets. Let's say there is a laundry shop. When the laundry shop has many detergents and softeners in the shop, they are assets. They are things owned and controlled by the business. But when the business use the supplies, it become an expense. In accounting, when a laundry shop uses detergents and softeners to provide laundry services, the supplies that are used have to be recorded as an expense. The account is called supplies expense. Okay, so let's see the example here. Let's say you have a laundry shop. Your shop supplies account has a balance of 2,000 in the unadjusted trial balance. So when you have a laundry shop, you have an account for supplies. That account is used to record the supplies asset. When you purchase supplies, you record. When you purchase the supplies from supplier, you record the supplies in the supplies account. Okay, let's say at the end of the year, the balance of the supplies, the balance of the supplies account is $2,000 in the trial balance. So some of these supplies have been used during the year. On December 31st, account reveals that $760 of supplies are on hand. So the situation is like this. You have a laundry shop. Your laundry shop, the account supplies at the beginning of the year, the balance of the account supplies is $2,000. But during the year, the shop uses the supplies. At the end of the year, you close your shop and then you calculate the balance of the supplies. You found that $760 of supplies are on hand or still unused. So how to do the recording for this? So for supplies, the first thing that you have to do is you have to calculate how much supplies have been used during one accounting period. So for this situation, to calculate the supplies used, see here 3 dots there. First, you have to show the supplies, the beginning balance of account supplies, 2000 for this situation. And then, see at the end of the year, at the 31st of December, the balance of supplies left is 760. So how many supplies have been used during the year? So you can calculate that $2,000 minus 760. So you can see that during the year, supplies that have been used equal to $1,240. Remember I told you, supplies when they are in the shop, they are asset. But when the business use the supplies, it becomes an expense. So the $1,240 an expense. Okay, so now you know that is the supplies expense during the year. The supplies used during the year is the supplies expense for the year. So how to do journal entry for this situation? So the journal entry is you have to record the supplies expense. Remember, according to the rule of debit and credit, an increase in an expense, you have to debit the account. So supplies expense before the situation is 0. Before the 31st December, there is no record of supplies expense. When you found that the supplies expense is 1240, you have to record that. So debit supplies expense. You have to debit the supplies expense account. The value or the amount is 1,240. And given that the supplies expense or supplies used are coming from account supplies, from the account asset supplies. So when you purchase the asset supplies or supplies goes in, you debit the account supplies. When the supplies is used and become an expense, you have to the supplies asset has decreased. So when supplies asset is decreased, you have to credit the account supplies as supplies asset. So that's why here the second journal entry is credit account supplies, debit account supplies expense because the expense has increased, credit account supplies asset. Why you credit that account supplies asset? Because there is a decrease in that account. The asset has decreased and become the expense. Okay, these are the I think I have covered all the adjusting entries and also entries related to depreciation and supplies. Later, I will show you I will show you sample questions related to adjusting entries. Thank you very much. That is the end of the lecture for today. Do not forget to write your name and metric number in the comment section. I will take that as the lecture attendance. Thank you very much.